strategic partnership that you have with Illinois Institute of Technology. And apart from that, it's the acquisitions which have been at the core.
First is, thank you for the opportunity. Let me just briefly explain what we are doing with Illinois Institute of Technology. We are having a strategic partnership with them at two levels. One is bringing a whole lot of their college level programs into India. And the other one is for the first time involving them in some of what we are doing in the K-12 school segment. I think in that it would be sort of one of the first in India where we are having a strategic tie-up to start impacting kids in schools. Veranda Learning has largely been built as a platform through acquisitions. We expect to do a few more, but this would be pretty much the last year when we complete what we call as completing the Veranda ecosystem and the fabric of what Veranda is. In a sense, what we are building out is a trusted brand that parents could rely on, students could rely on, starting from preschool, K-12, into colleges and post-schooling after that, and all test preps in between. We are building this platform one step at a time, all of it with a focus on acquiring assets which have pedigree and profitability. So Veranda Learning has delivered a first half year of significant EBITDA profitability. We expect to end the year at a significant profitability at the EBITDA level, which would be at about between 15 to 20% of our top line. The top line has also been growing in a healthy manner. Our FY23 revenues was about 200 crores. We expect our FY24 to close well over 400 crores, maintaining 100% year-on-year growth at the top line, while continuing to maintain a healthy EBITDA between 15 to 20%.
Right. So that's with regards to where the top line is concerned. In terms of profitability, how are you looking at it overall? Because we did see a marginal loss that did come in the second quarter of FY24 versus a 21 crore on a year-on-year basis. How are you looking at closing FY24 accordingly?
As far as our first half year, specifically Q2 is concerned, a lot of what you are seeing are provisions predominantly for goodwill, which is translating from the acquisitions we have done. These are non-cash, but still a provision that's being made for goodwill. And that sort of resulted in the numbers that we had delivered for Q2. Our EBITDA numbers continues to be healthy, and FY24 would possibly be the first year where Veranda Learning as a listed company might potentially have profit at the PAT level.
Right. Apart from this, if you see in terms of the business-wise breakup as well, taking the recent numbers into consideration between Veranda, Race and IAS, you have Uderica, as well as JK Shah and the acquisitions done in July, how is the revenue breakup expected to look like going ahead?
Predominantly for FY24, we expect JK Shah classes to deliver probably about 145 crores of the revenue. Race is expected to cross for the first time 100 crore at the revenue level. Edureka, which is our software upskilling platform, is expected to get closer to 100 crores this year. Since the majority of the acquisitions have been completed only near the end of the second quarter of this year, there will be a marginal impact, which is the rest of the revenue that's coming to our 400 plus crore top line for FY24, which is coming from the last set of acquisitions we did. But a significant part of the impact and a full 12-year impact will be seen for FY25.
Okay. And apart from this, if you see in terms of overall acquisition strategy, what is that expected to look like? Because is it going to be a business that is going to be built on acquisitions and expansion, or will it be expansion via franchisees and partnerships?
We do deliver our own centers. We do use franchises as a way of expanding. All our products are available both online and offline and in all hybrid formats in between. Having said that, we are building the business through acquisitions. I think two critical factors that are important from an acquisition perspective. Building a business through acquisition is really not a new strategy at all. It comes with risks. I think where acquisitions really work is what you do with the acquisition. And I'll just give an example. Veranda Race, when we acquired in December of 2020, had revenues of 40 lakhs for the month. This year, Veranda Race will close at a revenue of close to 100 crores. That creates value when you acquire a business. JK Shah Classes, when we acquired, had a EBITDA of about 20 crores. We expect this year JK Shah Classes to deliver an EBITDA in excess of 45 crores, which would literally double them 12 months from the time we acquired that business. I think that's what creates value from acquisitions, and we've been pretty choosy in what we acquire. As I mentioned, we focus on profit and pedigree of assets. Race was a 10-year-old brand. JK Shah is a 40-year-old brand that we acquired. Both of them are profitable assets, and we bring a level of empowerment and acceleration in terms of their growth. And a lot of what we are doing in stitching the fabric together is to create an ecosystem where effective cost of customer acquisition significantly comes down. And that drives our profit margins. We expect our long-term profits to be anywhere between 20 and 25% of the top line. And largely it's coming from a strategy of building a complete ecosystem. But just to go back to what you mentioned, this will come through our own facilities. This will come through leveraging on partners' capital through franchises, and all of it will be available online and offline.
Right. Suresh, another question I have is majority of the acquisitions were EBITDA negative in FY23. And you have said earlier as well that the aim is to make Veranda Race, Idurica business EBITDA positive in FY24. Is the company on track for the same?
FY24, we expect to deliver an EBITDA. Pro forma wise, it would be about 85 odd crores. The reported numbers could be about 65-70 crores of EBITDA for 24. There are a set of acquisitions that we are targeting, as I mentioned, which we expect to complete during this financial year. If we are able to lock in those acquisitions, FY25 will again see our top line growing by close to 100% year on year, and our EBITDA margins will track at a much higher level going into FY25.
Right. So as you mentioned about the acquisition targets, in what areas are they expected to be, and how much are you looking to spend on those acquisitions in FY24 itself?
So here are the parts of the fabric that we expect to fill. We are looking at something in the preschool space. We are looking at a few that will allow us to manage colleges and a few more schools. We are looking at assets in the study abroad space, which, as you know, has been growing very significantly over the last 5 years, almost 3 times in size. We are also looking for some tuck-in acquisitions into some of the verticals where we are already very strong. So it sort of forays us into managing colleges, preschools, and a couple of areas of test prep where we today do not exist. There are some early conversations in that space. That's pretty much will help us complete the grid that I spoke about in terms of the Veranda ecosystem.
Okay, so how much are you going to spend in terms of these acquisitions, and overall, how are you going to fund it? Because if I'm not mistaken, 100 crores is the cash in hand already that the company is sitting on.
As far as the acquisitions are concerned, again, it depends on, how many we are able to close at valuation that makes sense to us in terms of multiples of EBITDA. As you know, there are still assets that keep asking for multiples of revenue, which we don't do at all. We look at discounted cash flows of future profits. And hence, we are pretty choosy on the type of assets we work with. While multiple conversations are ongoing, we need to see how many we are able to close. But we are looking at seeing if we can acquire assets that will give us an additional EBITDA of about 200 crores or so.
Right. And my last question coming to you is, in terms of geographical expansion, what is it that you're planning? Because one, you do have courses that are offered through online, offline, hybrid, or offline blended, campus and campus, etc., various modes, right? and a diversified footprint across India. So in terms of geographies, how are you looking at expansion?
I'll talk in terms of specific assets. We are today the largest in South India for state and central government exams. And we are looking at specific areas of expanding that strength into the north. For instance, with JK Shah classes, we are looking at tuck-in acquisitions in various parts. Today, based on acquisitions we have done, we are the biggest in Kerala. We expect to be the biggest in Andhra, Telangana. There are discussions in multiple states that we are doing to geographically expand JK Shah classes. And the target is over the next 2 to 3 years will be the largest in the top 15 states in the country. This is in terms of physical expansion. We also look to expand on terms of the content portfolio. So while JK Shah classes is established eminence in CA coaching, we are going to expand that into cost accountant, company secretary, ACCA, CMA, CFA, CPA, and the larger perspective of commerce coaching itself. That's the second part of how we would expand. The third would be many of our assets have had significant presence and recall in the offline world. We are in the process of creating the online version of them to ensure that in the online delivery of the business, we also take the number one position. So in terms of being online and offline, geographical expansion to ensure that we are the largest in many more states than we currently are, and to ensure that we extend our dominance in the content perspective to beyond just where the core strengths are, but also look at logical expanding our strength in the other areas of content.
Right. So I think good growth strategy that is in the offing as well. Thank you, Suresh, so much for joining us on the show and sharing the views. So that's the management of Veranda Learning, where the stock has nearly doubled on a YTD on a 6-month basis is what we've seen. That's all that we have in this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to NDTV Profit. welcome to the Smith Show. You're watching NDTV Profit and I'm Hiral Badia. Joining us today is the management of Hariom Pipes. We have Rupesh Kumar Gupta, the managing director of the company, joining in. Rupesh, welcome to the show and a pleasure to speak to you as always.
Thank you. Thanks a lot.
Rupesh, overall, if you see from March 2022 onwards, a substantial growth that has come in with regards to where the company goes. Now, what has contributed to this kind of expansion in terms of growth, and what are the plans going ahead for the company?
So basically, thank you for inviting us on the show, and I thank Novama for this opportunity of meeting and all. So in Hariom, basically the growth parameters are growing year on year, and we see the growth is also pertaining to the demand of the market, and we are well placed in the market. That's the reason the growth is also coming upon. So we are well placed, as well as the brand is going good, and the acceptance of the brand is also very good in the market. That's the reason it's going on.
Right. So is this kind of growth sustainable from here on, or do you think this is something like a one-off? And how do you see your market share expanding there?
So fundamentally, it will be a sustainable growth. It will be growing year on year basically, and we see as rural areas and things are going on, and the acceptance of the quality as well as the spending power is increasing in the rural areas. That's the reason the product will also grow on. And as for the infrastructure and other things are also growing, so we see a good growth in the steel industry.
Right. Now with this, if you see from a margin perspective, say last 4 to 5 years, we've seen a 12 to 15% kind of a trajectory for the company. Now, globally, you're seeing coking coal as well as iron ore prices, which have surged close to 25%. How are the prices moving in the Indian market, number one? And how do you see the raw material prices impacting your margins?
So coking coal is not our product to go with. Like we use RB2 as an coal for the sponge iron. So the pricing of that is also very lenient towards it. And whenever the price goes up, obviously the price of the final product also goes up. So RB2 is around 9,000 to 10,000 rupees a ton, and it's competitive one. So we are getting it from South Africa, and that's more even competitive, and we are getting it easily.
Right. So will you maintain that 12 to 14% margin, or do you think there could be some softness from here on?
No. So we see basically the margin will be maintained thoroughly.
Okay.
Yeah.
And from here on, if you talk about the expansion as well, Hariom's concentration mainly has been the southern markets, right?
Yeah.
West is what you are looking to make inroads into. So where are you right now in terms of the strategy, and how much do you think will West start contributing to in terms of revenue, say in the next 12 to 18 months?
So in the southern market, what we see basically the total pipe consumption and other things are going well, and it has been accepted well by Hariom, and the consumers are very happy taking the material of Hariom. In the western market, as we are growing, that is an automobile market and the finished goods market, engineering products. Now we are adding on multiple products in our baskets. It's not only pipe that we are dealing in. We are now into coil, GP coils also. We are into CR pipes also. We are into GP pipes also. So multiple products. And as the market is growing, that products have to be enhanced. And we are just saving on the demand and supply part, wherein the consumer gets the material easily. So our target is to reach the end consumer on immediate basis, and the consumer should be happy taking the material with Hariom.
So when you say you're looking at different segments of business, how much of your revenues come in from pipes? And when you're talking about the other segments that you are looking to expand into, by how much do you think they will start contributing to revenues?
So 60 to 70% would be onto the pipe side, and the rest of the things will be the value-added products like the packing strip and the fan industry or the solar industry or the other catering needs of engineering products, automobile and all. This would be around 40%. So we cater 60% from pipes and 40% from other industries.
And when you talk about the 40%, which is value-added products, usually majority of the industries do demand higher margins on value-added products, right?
Yeah.
So if that is going to be 40, where does it stand right now?
Now, as we have started recently, our tandem mill and other things have recently started. We are under the process of getting the approvals from the other companies. Once it goes standard, it's not like only 40% is fixed on. We may move to 60%, also 50%. When the profits goes showing the profits and all, obviously our trend is to move on to the profit side.
So with this, by how much will your margins improve? How margin accretive will these value-added products?
So if at all we look today's margin, then we can add more 5 to 6% of margins additional onto that particular part. So as we are growing, we cannot even say today basically what exactly would be there. So the pricing part, what we are looking is very lucrative in terms of value-added products. So our focus is to just go on to the value-added products and maintain that particular things.
Right. Now, from a capacity perspective, where does the company stand? What's the utilization looking like right now?
So we stand at 58% of today's things, and we will grow up to 70 to 75% this year. So the standalone basically things are moving on good, as MS pipes are the older one, and the recent acquisition have started, that is also going good, and the new expansion which we have did is also under the things of moving out.
Right. So you're talking about GP pipe and coil as the recent acquisition.
Yeah.
So how much of that capacity has been added now?
So the 50% of the capacities are onto the use now for the GP pipes, and rest of the things which are there with the MS pipes and all are going on.
So from here on, for how many years do you think you will not have to incur a capex from an expansion perspective for pipes specifically, because you still, on a blended basis, you're still in that 70-75% range.
Yeah.
So, I mean, you plan to expanding it to 70-75% this year.
Yeah.
So, how much revenue potential does the overall capacity have?
So basically, it's not about the capex. We are not incurring any capex now. For next 2 years, we don't have any plan of any investment of capex. This infrastructure, what is there today, will enhance automatically. It will enhance to the capacities basically. As it is a new project which has come up, so only it is the time which is taking is of next 2 to 3 months what we are looking. So could be fourth quarter. After that, we will be enhancing the things into the better one.
Right. And with apart from this, any backward or forward integration that you've seen with the acquisitions?
Backward integration, yes. Any which time whenever we talk about the quality or things, then the backward integration is a part of the journey. So whenever the opportunity of going towards the backward integration or the forward integration, Hariom welcomes it and see that the profitability and the production capacity enhances.
Okay. Now, overall, from a product diversification perspective, the other value-added products that we've spoken about, where are we in from a capacity perspective for these products, and when do you see it actually contributing to revenues?
So if at all we talk today that the approvals and other things are going on from different segments of the industry, and we seek that within a quarter's time, next 3 to 4 months, we'll be getting the approvals, and once the approvals are there, then the product line will also get enhanced with the value-added products.
Okay, so what's the revenue you're looking at least in first year of business? So say FY25 is actually when we will see revenue coming in from value-added products. How much are you looking at, from a trajectory perspective?
So basically, our goals are to reach 2,500 top line of the revenue in 26, financial year 26. So we are targeting on that particular lines. Okay. So I think we'll reach that.
Right. Now, if you have to look at the key milestone that the company wants to achieve as well, what would that be if you have to look at the next 3 to 5 years?
So our goal is to reach the clientele, serve them as a service industry, not as a commodity industry. That's the reason we are adding on to the value additions. We are adding on to the multiple range, and the product basket which we are adding on undoubtedly gives the leverage to the company, and the customers should be happy. So our intake is basically let us serve the industry. Let us serve the people who are really dying to get the material. So we're looking forward way better. Basically, we should not think on only the profitability side, but also serve the needy. So in terms of the business.
Right. And with this, if you see 15 crores around was the profitability in the second quarter. If you have to look at the first half and the second half, is a 50 to 60 crore kind of a profit number that you will be aiming to achieve, or do you think it could be better?
Yeah, I mean, it's always depends on quarter to quarter, but when we yearly take out the average, we are growing in that particular substantiality, and things are going better. So quarter may vary, basically it can be lesser or the higher, but again we try to maintain the same things and we reach to that particular level. So yearly average, if all we take, that is better.
Right. So I think that's the number we should be watching out for as well. Thank you so much for joining us on the show and sharing the view. So that's Hariom Pipes clearly indicating their strategy and growth plans from here on. That's all that we have on this session. Thanks for watching.